Hey guys, welcome back to the channel. Today I'll be testing whether or not stocks actually fall in May. Now for this tutorial I'll just be using and focusing on stock indices, and here I've included the S&P 500, the Dow Jones, the NASDAQ index, and the Russell. So let's go ahead and get some data from Yahoo Finance. I'm going to send the data to a new environment, and I'll be focusing on data starting from 1970. Next I'll merge all the closes together, the lows, and also the highs in separate variables. Now that we have daily data, I just want to focus on the month of May. So what I'll do is just subset the month of May for all the years, and I'll go ahead and do that by running the following lines. So if we take a look at one of those variables, later down the code I'll go ahead and remove these NAs, but for now I just want to put all these indices together. The next thing I'll do is format these column names. So let's go back to our script. In order for us to isolate just the ticker for the column names, I'm just going to remove the dot close, the dot low, and the dot high for each of these variables by running the following lines. Since I am getting the data from Yahoo Finance, their data always lags a day. So here I'm just testing whether or not the last row matches with our current date. If it doesn't, then I'm going to go ahead and get the latest quote, and I'm going to R-bind in order for us to get the most up-to-date data. So that's all I'm doing here. I'm going to go ahead and minimize this block and run it. Alright, so for the next section, I'm going to generate a table for all these indices by year. I'm going to return the performance of each index for the month of May, along with the percentage return had you bought the very first close and sold it at the very high, and also the return if you would have sold it at the very low. So I'm going to go ahead and minimize this block and run it. I'll then row bind all the data together into this data frame, and we'll go ahead and take a look at that data frame. So here we have the NASDAQ index, and for each of the given years we have the monthly return, the percentage to the high. So again, I'm buying the very first close of the month of May for each of these years and selling at the very high. And the very last column is the performance to the low. So again, if you would have bought the very first close of the month of May and sold it at the very low, this would be the performance as a percentage. And the next thing we'll do is plot histograms and compare all the indices. So let's go back to our code. I'm going to use ggplot. So if we go ahead and run this, and we'll take a look at the plot. Alright, so we have 4 histograms plotting the monthly performance for each of these indices. So we see that for the month of May, we don't necessarily get a sell-off, especially in the S&P 500, which we see the most cases occurring at the zero line. And for the Dow Jones, we actually have the most cases on the positive side, along with the NASDAQ and the Russell. And for the NASDAQ, we see the worst return out of the 4, having a performance of negative 15% for one of its years, which I believe was when the dot-com bubble burst. But for the rest of the indices, we do see that for the most part, they stay in between negative 10 and positive 10%. And for the majority of the instances, the S&P 500 stays relatively close to zero for this month. All right, let's go back to our code. One of the things I wanted to test was whether or not the month of May had any positive returns following an election year. And I wanted to test this because usually when a new president comes into office, they will issue new policies, sometimes reforms that might help the economy and the stock market as well. So starting from 1973 until this year, we're going to go ahead and get the returns for each of those years and see if there's any significance there. So here I'll create a sequence of dates. So from 1973 all the way to 2021. So I'll go ahead and extract each of those years into a new variable called elect years. So I'll go ahead and run this block. I'll row bind all the data together, and we'll take a look at the detailed summary. So I'll go ahead and run these lines. The first column has the month of May following the election year, and the second column has all the data. So we have 43 observations, and this is a pool of all the indices, so that's why we have so many observations. So right off the bat, we see that we have a minimum of close to 5%. That was the worst case scenario compared to the negative 14. So if we take a look at the median and the mean, we get about 2.5 to 3% versus having a 0% return if we compared it to all the years. The maximum return was relatively the same. We get a smaller standard deviation for these post-election years compared to all the years. We also have a positive skew compared to a negative skew if we use all the returns. So my take of this is that we actually do see a higher return post-election years compared to the data as a whole. If you want to compare these returns for a specific index or ticker, you may do so by running the following lines. So here we'll just take a look at the S&P 500, and we'll take a look at the detail. So if we take a look at the median and the mean, we do see it be 1% higher than compared to the data as a whole. So there might be some significance there. All right, so let's close this out and continue with the script. So I just want to plot the cumulative return per year. So I created a function here that will just subset and plot the cumulative sum of returns for each of the years compared to the most current year. So let's take a look at the Russell. So the grayed out lines are the cumulative sum of the returns for the month of May for the Russell, and the dark line or the black line is the current year. So right now it's kind of staying along with the rest of the years. But if we take a look at the Dow Jones, which I believe is the only one that is showing signs of strength, and I believe this is the only index that is actually trending higher, and the worst one I believe was the NASDAQ. Now let's do the same but for election years. So let's do the Dow Jones again. So the lines in gray are just the cumulative sum of returns following an election year. So for the Dow Jones, we see that for the most part these stay on the positive side, and the black line symbolizes the current year, which we see is on a trajectory to the upside. But let's compare that to the NASDAQ. So if we take a look at the NASDAQ, so for this index, we see that it's not off to a great start. It is trending towards the negative side. So hopefully this index starts picking back up again, but I would worry if this index continues to decline. So whether or not we might have an anomaly year for this index, I guess we'll have to wait a couple more days until this becomes a little bit more clear. So I'll go ahead and post this script on my GitHub so you guys can play around with it, and you can also test different tickers if you don't want to focus on indices. Let me know what you guys think. I hope this video was useful. Please subscribe to the channel if you haven't done so already. Thank you for watching, and I'll see you guys in the next video.